When the global financial crisis hit in 2008, the U.S. Federal Reserve lowered interest rates to near zero to help the economy recover. The U.S. stock market quickly rallied. It's been on a tear for much of the time since then, in large part because of loose monetary policy.
Since 2008, we've been in this very low interest rate environment where quantitative easing, successive rounds by the Federal Reserve Bank of the United States, has created a situation where interest rates have been very low.
Growth stocks in the tech sector have done particularly well in the low-rate environment.
It was the first time in history, in over a century, where you could buy a basket of stocks trading at 10 times sales, not earnings, sales, and make money.
But the era of free money is coming to an end. The Federal Reserve has indicated it will begin raising interest rates to combat record high inflation. Tech stocks like Netflix, Roku, and Meta have all tanked in recent months.
Interest rates tend to impact the economy about a year after a rate hike. The impact on the stock market is much more immediate. That's because investors know that rising rates increases borrowing costs for businesses and leads to a decrease in consumer spending.
Both hurt profitability. Some say the party on Wall Street is over, but Hayes believes investors are just going to be more discerning.
I think now you're going to see a tremendous amount of investor capital go to those companies that have high free cash flow yields, that they can use that cash to buy back stock, to issue dividends, to do accretive acquisitions, and that's where the party's going to be moving forward.
Hayes and Dong say rising rates and the conflict in Ukraine are likely to continue to hurt U.S. stocks, but both believe the market will rebound in the long term. It'll just be a slow march higher.
I dare say that the market, I think, will still outperform the bond market, but in terms of like the sort of like, double digit, rapid growth and advancement of some of these share gains that we've seen in the past 10 years, it might be a different environment altogether.
Investors are advised to fasten their seatbelts for what is expected to be a bumpy ride. Karina Huber, CGTN, New York.